That would imply roughly 450,000 per coin sometime after the next halving. And then we also have a long-term model, similar to Michael Saylor's, and we get to $3 million a coin by 2050.
Hey everyone, welcome to the Coin Stories podcast. I'm Natalie Brunell, and joining me today is Matthew Sigel. He is the head of digital assets research for VanEck. Matthew, thanks so much for joining me.
Thanks for having me, Nat.
Well, lots to talk about. Bitcoin, I think, is back up over 100,000. It's been a crazy few months. You look at all of this so closely. So why don't we just start with kind of a zoom out? What is your outlook and what is your reaction to how well Bitcoin's been performing recently?
Bitcoin at 0.1 million is a landmark number. We've been bullish on the space since 2017. VanEck was the first traditional ETF and mutual fund sponsor to apply for a Bitcoin ETF. So it's been a big part of diversifying our asset base away from our traditionally heavy allocation to gold. So being able to invest through the bear market and now reap some rewards during the bull market, obviously very validating.
Can you talk a little bit about the institutional adoption that you've seen? To me, I get the impression that it is increasing, but we still have a long way to go.
Yeah. The institutional adoption of crypto, I'd say, has still been somewhat disappointing from my perspective. Okay. So VanEck's traditional customers are the bank and broker-owned asset managers. Think Morgan Stanley, Merrill Lynch, UBS, heavily regulated institutions that typically set an asset allocation framework at the very top, some variation on the 60-40 portfolio, and then the advisors will sell ETFs or single stocks that align with that asset allocation. Because of kind of regulation and innovator's dilemma, those institutions have been pretty slow to proactively sell Bitcoin ETFs, nor have they altered those asset allocation models to include Bitcoin. So what's remarkable is probably 80% of the ETF holders are individuals or high net worth diversifying away from self-custody or adding to positions. And we really haven't seen those spigots of the institutional asset managers pile in yet. Where the institutional adoption has occurred is at the sovereign level. So there's now 7 countries that are mining Bitcoin using government resources. That number's doubled in the last 18 months. And then the corporate adoption, private and public companies. Those holders have tripled their Bitcoin holdings in the last couple of years. MicroStrategy is obviously the poster child, but we count now more than 60 public companies that have added Bitcoin to their balance sheet as a reserve asset. The first Indian company did that this week. So when you compare gold to Bitcoin, what you find is Bitcoin ownership is still dominated by retail. Nearly 60% of the holders of the ownership is retail, and it's underexposed to governments and corporates, and that's where we do expect increased adoption next year, and then hopefully these big wirehouses will put out new models, right? New variations on these 60-40s. But if they don't, that's our opportunity because VanEck traditionally selling ETFs and mutual funds, but because of client demand, we've started to build some of these models ourselves, very diversified portfolios with, call it a 1 to 5% allocation to Bitcoin. And that's been some of the fastest growing parts of our business. So
it's really interesting because I recently had Bloomberg intelligence analyst Eric Balchunas on the show talking about how historic the flows have been for these Bitcoin ETFs and predicting that they're going to 3x the gold ETFs very soon in the future. And he said about 1,200 corporations have been investing in it. And then you hear analysts like Jim Bianco, who's very bearish and says, oh, there aren't a lot of institutions actually adopting. So it's kind of confusing. Can you sort out sort of why there are such contradicting opinions on the success of these ETFs?
Well, the success has been historic. They're the best, they're the fastest growing ETF launches in history. So it's hard to call them a disappointment. But I think that divergent opinion comes down to how close to Wall Street are you? If you're looking at the half dozen or so systemically important banking institutions that also have wealth management and asset management arms, they have not been aggressive on adopting Bitcoin ETFs. Maybe that's where Eric's optimism for next year, comes through. The holders are, individuals, high net worth, independent advisors who have kind of less of that, the regulatory hurdles.
What are signposts we should look for that the tide will change and more institutions will adopt Bitcoin? And what are these institutions looking for?
I think part of it has to do with the SEC's accounting rule, SAB 121, which makes it very difficult for banks or publicly traded brokers to custody Bitcoin. So if that rule were to be reversed, and we expect it will be in the first half of next year, either the SEC can reverse themselves or Congress could pass another law overturning that rule, and this time it would not face a presidential veto. And that would pave the way for large banks to actually offer Bitcoin to clients and custody it. So imagine if you could log on to your, Chase online banking account and you could toggle over and see your Bitcoin holdings or add or sell your Bitcoin. That would turbocharge adoption. We may be still some ways from that. So the first thing I'm looking for are, twists on the 60-40 model that include Bitcoin at a 1% allocation, bringing down the minimums that financial advisors need to sell these ETFs. So at companies like UBS, clients still need to have a multi-million-dollar portfolio before the advisor can recommend a Bitcoin ETF. I think a lot of that is regulation and more comfort that there won't be enforcement actions if the wealth managers do that. But first, we got to get SAB 121 off the books.
Got it. And a lot of people think that will happen pretty soon. A lot of people very bullish on this administration. The tide seems to be turning when it comes to the regulatory environment that we expect to have under Trump 2.0. Coin Stories is proudly brought to you by Bitdeer, a global leader in disruptive technology for Bitcoin mining and AI. As a publicly traded leader, Bitdeer boasts a massive 2.5 gigawatts of electrical capacity and infrastructure under development across 3 continents, positioning Bitdeer as one of the most diversified and power-dense computing companies in the world. Bitdeer's leadership pioneered the original advancements in Bitcoin mining ASICs and is now poised to disrupt the market again with groundbreaking new designs for the next generation of mining ASICs that are targeted to reach efficiencies of as low as 5 joules per terahash by late next year. Now they're leveraging years of expertise in data center and cloud management into high-performance computing through a partnership with NVIDIA. Join Bitdeer in reshaping the world of Bitcoin mining. Learn more at bitdeer.com and explore how they are pioneering the future today. Do you think that we will get a strategic Bitcoin stockpile or reserve?
So the betting odds for that are somewhere in the 30 to 40% range. I do think that it will happen, but it may not be a legislative event that prompts the government to buy Bitcoin in the open market. I think more likely it'll be an executive action that tries to reclassify the roughly 200,000 Bitcoin that the U.S. government already owns, having seized in crimes or other events, and just kind of call that a Bitcoin reserve and pledge not to sell it.
Right.
Our prediction for next year is that there will either be a national Bitcoin reserve like what I've just described, or that one or a handful of states will pass their own. And I think the most likely candidates for that are Pennsylvania, Florida, or Texas. And then there's obviously the international reaction. Several foreign countries, notably a legislator in Russia, just put forward a bill to establish a Russian strategic reserve of Bitcoin. So, as you've highlighted many times, the game theory of this appears to already have kicked off.
Well, what about the Bitcoin Act? The idea that we might either reprice the gold that we own and then use that to purchase Bitcoin, sell some of our gold to buy Bitcoin. Do you think that's possible?
I think it's possible, but unlikely with the current Congress. We may need one more cycle to, get lawmakers from both parties on board, which is what it takes to get most legislation through Congress. The
gold bugs are so interesting. Sometimes I do shows and it'll be for an investing audience that has a lot of gold bugs, and they are so negative about Bitcoin still. And it's sad to me because I feel like the principles and the values behind gold are so similar to Bitcoin. But when someone comes to you and they're new and maybe they see the value of something like gold, but they just don't understand Bitcoin, how do you explain the value proposition and why people should start to have at least like a 1% allocation?
Yeah. Well, I have to constantly remind myself that Bitcoin is not an asset that is most appropriate to American people, frankly. Like, we all have 5 different credit cards, 10 different payments apps. There's many ways for me to send you money. It's not technically peer-to-peer, but you'll receive it right away. And our institutions are trustworthy, relative to many of the institutions around the world. So Bitcoin is, it can be a hedge against the government either devaluing or seizing your money. And it's most appropriate for the billion or so citizens of the world who live in countries where inflation is greater than 10%. And when you look at surveys of consumer optimism to Bitcoin, you see that the most optimistic countries are young emerging markets like Turkey, the Philippines, Vietnam, and the most pessimistic countries are France, Germany, Japan, right? So it's not only EM versus DM, but it's also demographics, right? The optimistic countries tend to be young and the pessimistic countries tend to be old. So we think of it as a demographic play geared to EM, where fiat currencies are even less trustworthy than the US dollar. And so while the ETFs unlocked the speculative utility, the way for Americans, developed market investors to get exposure to that asset, it's not really the full utility. And you have to go overseas and talk to some of these regular people. That's how I first got my conviction, was through individual conversations with taxi drivers, basically, who said that they're into this asset. And I was working on Wall Street at the time, and I came back and told the trading desk, and they're like, that's a contrarian indicator. You sell when the taxi driver is bullish. And I didn't take that advice. I thought, this is actually the anti-Fed money. It's not going to be something that is initially blessed from institutions who have a lot to lose. It's going to be a retail asset. So I took the other side of that trade, thank God.
Wow. Well, and so you're really passionate about the emerging markets. You specifically recently did the report on El Salvador. Can you talk a little bit about that? I've had the chance to visit myself, and I saw actually a mix of two worlds. When you go to Bitcoin Beach in El Zonte, it seemed like everyone was embracing Bitcoin. But in San Salvador, it was a mixed bag. I met people who were very skeptical and very worried. And when they received the Chivo wallets and their Bitcoin, they converted it right away to fiat. So it was mixed. But what are you seeing, and what do you want people to know about the future of El Salvador?
Yeah, I think that there are a couple dozen countries in the world that had to abandon their own currency. In the case of El Salvador, they had a civil war. It was a highly inflationary environment, and they lost control of their own currency and had to dollarize. There's a number of countries like that around the world. Many of them have borrowed billions of dollars from the IMF and are having a hard time repaying it. At any given point, about 5% of global GDP, countries representing 5% of global GDP are in some type of default versus the IMF. And what happens is the IMF comes in, they're like, hey, that loan that you can't repay? Well, we'd be happy to extend it, but you have to satisfy, the following conditions. And often those conditions include tax hikes, right? So imagine that you're president of one of these countries and you have to sell to your citizens that some foreign, institution controlled by the U.S. is telling you to raise taxes. It creates a uncomfortable political dynamic. It often emboldens the opposition. And to either threaten to adopt Bitcoin or actually to adopt Bitcoin in the case of El Salvador, that reintroduces some negotiating leverage for these countries. And I think it can restore sovereignty and make regular people more optimistic about their own country. So that's what we noticed in El Salvador. And actually, of the 3 countries this year who are newly mining Bitcoin using government energy, essentially, Argentina, Ethiopia, and Kenya, all 3 have IMF programs that are either in default or in jeopardy of being defaulted. So that's where we think that the adoption is most likely. I've been visiting El Salvador for 4 years now, since they adopted Bitcoin as legal tender, and have been pretty impressed at the adoption. So about 8% of El Salvadoran citizens have used Bitcoin for payments.
That seems low.
It seems kind of low, but it's not. I think it's reasonable. For a country where the average person is making $10, $20 a day, and they're basically eating what they earn every day. It's not their primary. They're not primarily motivated by savings.
Sure.
And we've done a lot of conversations with taxi drivers, and I heard great optimism about the Bukele administration, about the ability to, have your kids play soccer at night without being hustled for protection payments. And I heard a lot of optimism that even though Bitcoin might not be the currency of today, it's a symbol that the government is being forward-looking about what the technologies of the future may be.
Yeah, for sure. I heard the very same. But isn't it an IMF stipulation that they can't use Bitcoin? Because I thought that currently El Salvador actually needs to tap in and get a little bit more money, and they might have to change their tender laws to essentially say that businesses can't, they don't have to accept Bitcoin, but they can if they want to. Did something like that happen?
Yes. So there was a news story this week that El Salvador will change the requirement that all merchants accept Bitcoin. Yeah. That requirement was always kind of fuzzy anyway. So it only applied to big businesses, not to small stores, because it's hard to make a mom and pop bodega accept Bitcoin against their will. And there's actually other examples of this around the world. Like the Canadian dollar is legal tender in Canada, but you can't go in and buy something with $10,000 in cash. The merchant is allowed to not accept that. And there's other cases of that as well in some of the British overseas territories. So I think it's Bukele's trying to thread the needle here, get access to financing, keep the legal tender, but remove some of the more onerous kind of enforcement provisions. So I still think that, having met him in the last couple of weeks, he is very committed to Bitcoin. And I think that there's actually a lot of people who will be happy about this move, because for freedom-loving Bitcoiners, they didn't love the idea that a merchant would be required to accept Bitcoin.
Yeah, I love when they post the wallet and how much it's appreciated for El Salvador, because he was so early. Circling back to the West, I want to talk a little bit more about what institutions are doing. And lately, I'm sure people that are watching this or listening have seen announcement after announcement of companies buying more Bitcoin or issuing convertible debt, just all these unique strategies, ATM offerings to just buy more Bitcoin. And now the miners are even doing that. I want to get your reaction first to that.
Well, MicroStrategy is the pioneer here, and what Michael Saylor discovered and profited from was the conviction that portfolio managers in the convertible bond universe want exposure to Bitcoin. So that's really the niche that he's going after, is that there's a whole asset class of convertible bonds. These are typically, quite sleepy fixed income instruments. And now MicroStrategy convertible bonds represent 5% of the iShares BlackRock convertible bond ETF. So, portfolio managers look for performance. If there's something that's working, they want exposure to it. And these MicroStrategy converts are finding great demand. There may be a time when the alternative becomes true. If every company in the world starts issuing convertible bonds and buying Bitcoin with the proceeds, eventually there would be too much supply and the model would flip. But we're still so early in the adoption cycle that for now, these issues are finding strong demand. And when you look at the universe of Bitcoin miners, US-listed Bitcoin miners now control about 30% of the total Bitcoin hash rate. That's quite a large number. It's grown up from, say, 20% over the last couple of years because the publicly traded Bitcoin miners have access to cheaper capital than private companies. And one of the ways that they raise that capital, some of it is through share sales, and then some of it is through these convertible debt or other debt issues. So during the bear market or during like the first half of this year when Bitcoin market was more trending between, say, March and September, the Bitcoin miners that outperformed were the ones that were pivoting to AI. The Core Scientific, TeraWulf, Iris Energy, they're sitting on large electricity capacity, and they're finding bids from hyperscalers, AI companies, GPU cluster companies to buy some of that electricity capacity up front. Not only that, but also fund the CapEx to install GPUs. The revenue per megawatt is much higher for that model for the Bitcoin miners. So a number of them, pivoted some portion of their capacity. The stock market loves it because it's a more predictable revenue stream. So it brings down their cost of capital. And those stocks really outperformed from, say, March to September. Once Bitcoin started to take off, then the market is looking for pure plays or leveraged plays. And so the companies, the Bitcoin miners that were less aggressive about pivoting, like Marathon, who doesn't love the AI model as much as some of the peers, they doubled down on this HODLing strategy. And when Bitcoin's going parabolic, that's what's going to outperform. So kind of too early to say over the cycle, which is going to be the more profitable model. That's why we're running, diversified portfolios, like our DAPP ETF, which holds companies that are pure plays in Bitcoin and digital assets. So MicroStrategy is one of the largest holdings. Coinbase is one of the largest holdings, but we basically have all the Bitcoin miners. And past performance, no guarantee of future, et cetera, but that fund's now outperformed Bitcoin for the last 2 years.
Wow.
So in the upcycle, I think you need a combination of the hodlers and the more conservative miners.
This episode is brought to you by Casa. As some of you know, I recently updated my self-custody, and Casa makes self-custody so easy even if you've never held your own keys or used multisig before. Casa has a state-of-the-art app and live experts standing by to guide you every step of the way. For those with large Bitcoin holdings, Casa just rolled out a new service. It now offers a holistic security advisory service. As a private client, you'll get a 7-step security overhaul, personalized consulting, and your own private emergency line for expert help when you need it most. Get 10% off your Casa plan at casa.io/Natalie. Next up, Speed, the fastest growing Lightning wallet in the world. Send and receive Bitcoin, swap with stable coins, and even snag gift cards to earn rewards, all in seconds. Download Speed via the QR code or the link in my show notes and use code CoinStories10 for 5,000 free sats. And finally, are you ready to take control of your wealth? The Bitcoin Way is here to empower you. Learn how to take full self-custody and eliminate all counterparty risk. Set up a node and become the master of your own transactions and enjoy true autonomy. And upgrade your cybersecurity and protect your online privacy like I did. The Bitcoin Way specializes in personalized one-on-one training to help you become fully self-sovereign. Schedule a free consultation today. All right, back to the show. You've been tweeting about something called the JPMorgan HODL premium, I believe it is. Can you talk about that and what that means?
Yeah. So the sell-side coverage of Bitcoin miners has been interesting to observe because typically the sell-side brokers are, mega banks like JPMorgan, who's historically been more cautious on recommending Bitcoin to clients. So they've been kind of behind the curve. Some of their price targets on the Bitcoin miners have been too low, and the stock prices have already overshot. So this week, the analyst came out and upgraded a bunch of Bitcoin miners, and basically in his sum of the parts model, he's assigning a premium to the Bitcoin hodlers on the theory that they will be able to replicate what MicroStrategy has done, basically issue debt and find willing buyers in the fixed income universe. So they're just kind of marking their numbers to market and comping these pure play Bitcoin hodlers more closely to MicroStrategy.
Well, I mean, Bitcoin has gone up on average, the CAGR is like 40 to 60%. And if you're conservative, like I've seen some of Michael Saylor's models into the next 21 years, and it's like maybe conservatively, let's expect 20 or so % every single year appreciation. Isn't it just the best strategy for more companies to evaluate putting it on its balance sheet? Because it's very hard for a company to grow at the rate that Bitcoin's growing. And so to have that just supplement the company's valuation, why isn't everyone doing this?
Well, there's a difference between hodling the Bitcoin and issuing debt to buy and add to your Bitcoin position. Anytime you introduce debt, combine debt and Bitcoin, you're really turning up the dial on risk. And when we look at last cycle, basically all the corporate lenders of Bitcoin, whether it's Celsius or BlockFi, Genesis, they all went bankrupt. A number of the Bitcoin miners who were leveraged also went bankrupt. So there was those stocks went down, 100%. They restructured, emerged from bankruptcy. I'm thinking about like a Core Scientific who emerged from bankruptcy in January of this year. Now it's been a great stock, but if you held it through the cycle, you lost all of your money at one point. I think that if you're trying to run a diversified fund, it's nice to have many different choices. And in the most explosive parts of the cycle, the leveraged ones are good. But I think that what the market wants to see from these Bitcoin miners is consistency. If you say you're a hodler, then set up your business model so it can be sustainable and you're not constantly relying on new financing to buy your Bitcoin, because when the cycle turns, that model won't work out.
The idea of a company purchasing Bitcoin for the balance sheet, like spot Bitcoin to add to their treasuries versus purchasing an ETF, does a company have a choice to do either, or why would a company do one versus another?
Yeah, that's a good question. I remember right when the Bitcoin ETF started trading in January, there was a big price spike, and that quarter, Marathon actually said that they bought the Bitcoin ETF one of those days because they noticed some arbitrage available, and that was the easiest way for them to get exposure to it. So I think that there's an argument to diversify, and some corporate Bitcoin holdings should be put in self-custody, cold storage, and some into the Bitcoin ETF. The ETFs are clearly very cost effective. I think it's a legitimate strategy. But, if you're adopting Bitcoin as your treasury asset and you want to appeal to the community, it's also nice to be able to say you have those coins in cold storage. So MicroStrategy, for example, doesn't hold any of the ETFs.
There are some people who watch this and follow my show who are kind of anti-institution, and they're skeptical of big corporations getting involved. And one thing I noticed when I was looking at your Twitter is you retweeted Roger Ver's interview, which was very much, I think, of the ethos that, hey, we should not trust government. Government is hijacking Bitcoin. And you work for an institution, so I want to get your take, because again, I feel like the audience tends to bifurcate. Some people are very much in the traditional world, or they see Bitcoin assimilating with the legacy financial system, and others say, no, this is an inherently revolutionary asset. It is anti-bank, anti-institution, and we want to keep it that way.
Yeah, I think that kind of goes back to my comment on developed markets versus emerging markets. Mm-hmm. The utility of peer-to-peer transfers and self-custody is just more pronounced in the emerging markets, where the risk of the government taking your money by force is higher. So to those in the U.S. who want to believe in the ideology of self-custody and, have disdain for centralized intermediaries like VanEck, I would just argue that that's very naive, that in a fiduciary relationship, if you hire someone to manage your money for you, then there's laws and regulations in the U.S. that prevent that money manager from holding on to the assets themselves. Because time after time, over hundreds of years, what you've seen is that money managers who hold the assets themselves tend to steal it. So we have a separation of power, laws in the U.S. It's kind of like the balance of power in government. And the money manager has to hold their assets with a custodian, mm-hmm. right? So that would be in traditional securities, someone like a State Street or a Bank of New York. So in the VanEck Bitcoin ETF, we can't hold those assets in VanEck wallets. We have to hire a qualified custodian who's regulated. For us, that's Gemini, who has an entity in New York State, which is regulated by the New York Department of Financial Services. It's bankruptcy remote. They're not allowed to lend that Bitcoin, rehypothecate it, anything like that. And that's just the laws of like fiduciary relationships. So for one's own personal stash, I'm all for it, self-custody. Yeah. But if once you hire someone else to manage your money, that person can't hold the coins themselves. And that's where the ETF unlocks that entire trillions of dollars of regulated assets.
Got it. Okay. So do you think that self-custody will be protected by government actors, say here in the U.S.?
There are some laws that have been proposed at the state level to protect the right of self-custody. I'm not really sure what that means in practical sense. So I don't ascribe too much importance to it. The laws and regulations around fiduciary relationships are not likely to change. A money manager won't be able to hold their coin, unlikely to hold the coins themselves, probably in the near term, like 1 to 2 years.
But if you're an advocate for people taking self-custody, do you think that they'll be able to? You said, let's say 10 years from now, if Bitcoin now underlays the entire financial system as pristine collateral and as the deep store of value and the best capital network, will we be able to take self-custody?
At the individual level, clearly, yes.
Okay.
Yeah. At the institutional level, I think it'll be a diversified situation. So maybe the regulations will change that will allow fiduciaries to hold the coins for their customers. And some are already doing that. It kind of depends if you're SEC regulated or not. And then let's assume that SEC regulated money managers like VanEck are allowed to hold customer coins. I'd say we'd still diversify and probably hire a custodian to do part of it, just from a risk management perspective.
What is your outlook for this asset, let's say, over the next 12 months?
Sure. So when we look at previous cycles, the pattern becomes very clear. Bitcoin outperforms everything else for 3 out of 4 years. And then in that 4th year, there tends to be a large drawdown, say 60 to 80%. And that down year typically is the 2nd year after the halving. So the Bitcoin halving occurred in April of this year. So 2024, strong year. 2025 should be a strong year. I think 2026, unless something changes, would be a down year. Yeah. And when we look at the trough to the peak in each of those 4-year cycles, each cycle gets a little bit smaller. The smallest ever trough to peak appreciation for Bitcoin was 2,000%. So let's say that we cut that in half and say it's going to be 1,000% this year or 1,000% this cycle. Bitcoin troughed around 18,000. So I see an upside to 180,000 this cycle. And I think that's likely to happen next year. So it's a very volatile asset. We can overshoot it on the upside or on the downside. But I'm looking at that kind of technical backdrop.
Okay.
And then we're looking at a number of what we call topping indicators to just tell us like when the red light is really flashing. And if all those lights are flashing and the price is 150K, I'm not going to wait, right? But if we reach 180K and none of those lights are flashing, maybe we let it run. And some of those indicators include the funding rates, so how much it costs to put on a derivatives position. When the funding rate for Bitcoin exceeds 10% for more than a couple months, that tends to be a red light. We're only like less than a couple weeks at this moment, and yesterday's washout eliminated that as well. So funding rate's not really flashing red. Unrealized profits, because you can track on the blockchain kind of what everyone's cost basis is. So that is also, we're not seeing scary amounts of unrealized profits. And then like anecdotal evidence of just widespread retail leveraged speculation. That's a little bit more qualitative, but again, not seeing that as well. So we're my base case is something around 180K for next year. And then over the medium term, we think about Bitcoin relative to gold. About 50% of gold is used for industrial or jewelry purposes. So cut gold's market cap in half, and maybe that's our target for Bitcoin for the next cycle. That would imply roughly 450,000 per coin sometime after the next halving. And then we also have a long-term model, similar to Michael Saylor's, where we assume that Bitcoin is held as a reserve asset by central banks. Although at a very low weighting, we're predicting a 2% weight for global central banks. They hold gold at an 18% weight, so it's very small. And we also assume that Bitcoin is used as a settlement currency for global trade, most likely among BRICS countries, but also some in the developed market. And we get to $3 million a coin by 2050, which would be about a 16% compound annual growth rate. So you observed that the growth rate in the last 10 years is closer to 40 to 50%. So it's a pretty notable deceleration.
Wow. Well, going back to the game theory, when we have other nations looking at potentially creating Bitcoin strategic reserves, and we have had such bullish rhetoric from President Trump, is it possible that if they decide to do something, that Bitcoin could just skyrocket and hit, 7 figures in the next 2 years?
It's always possible because the supply is very constrained. So if gold demand 10x'd over the next year, suddenly there'd be a lot more gold that you would find in supply, right? I think China just announced that they found like some $1 trillion gold reserve. El Salvador's talking about $1 trillion gold reserve. Costs a lot of money to dig that stuff out of the ground. Often higher prices are the catalyst to make it affordable. Bitcoin's not like that. So, I wouldn't say never, but I think a 10x in 2 years, it's beyond what my expectations would be.
Okay. And did you hear Michael Saylor's interview clip where it was just this past week? He was talking to Alex Thorne, and he said something about how if essentially we demonetized gold, that would send a trigger to the other central banks that have really only been buying gold, that now that we're moving to the Bitcoin standard. Do you think that anything like that could happen?
That sounds reasonable if Senator Loomis's bill were to pass and we actually did revalue some of our gold reserves and swap it to Bitcoin. That's just not my base case. Okay. I'm finding it hard to believe that Congress is going to pass something that puts kind of taxpayer resources at risk. What I would like to see is incentives for Bitcoin mining that maybe give the government a piece of the pie. President-elect Trump has floated the idea of building 10 new freedom cities throughout the U.S. on federal land. So these would be brand new cities, essentially special economic zones that would revitalize a culture of building. They would require a lot of energy infrastructure, theoretically, to build new cities. Why couldn't Bitcoin miners be involved in the establishment of those new cities, help to catalyze some of the energy investment that would be needed, and maybe the government could take a little royalty on whatever Bitcoin they mined if they get tax breaks other ways. So I think there's a way to think about this not in a zero-sum way where we're actually selling gold, but where we're just incentivizing building in the US, specifically of energy infrastructure. And then Bitcoin miners can play a role, monetize some of that energy, and maybe the government can take a piece.
Let's talk a little bit more about energy because the demand is only increasing. We have to find cheap, efficient sources. Nuclear is something that has been talked about more and more. Doesn't VanEck have a nuclear ETF that you've tweeted about?
Yes. So we have a fund. The ticker is NLR. It's nuclear-oriented ETF. What makes it unique is that instead of just owning the uranium and the uranium miners, as many of our competitors do, we look at the entire ecosystem from the utilities to the equipment providers and the uranium. And so what you end up with is a more diversified fund with lower beta. It's just less volatile because there's utilities involved. It pays a yield, but all of these companies have material exposure to the nuclear industry. So that's been a very strong performing fund with a lot of interest. We're actually just filed for an active version of that fund. So yeah, we do think that the investor and consumer attitude towards nuclear is changing. I was actually in Japan, lived in Japan in 2011 when the Fukushima tsunami and nuclear meltdown occurred. I was working at a fund that was heavily invested in nuclear at the time and watched the attitude really change. But now, 10 to 15 years later, people have forgotten about that. And, I'm still, having lived through that and watched how people react, no pun intended, when there's a meltdown nearby, it's the emotions are extreme, right? And there's going to have to be, I think, a lot of preparation at the government, like federal, local, to establish safety guidelines, how people should react, when there's trouble. But the growth, especially with the big tech companies now, essentially soliciting nuclear capacity and some tech innovations in the space, I think now's a good time for more nuclear. Yeah,
I think it's going to grow so much. And it's interesting that you say that about the meltdowns because my mom grew up in Poland. And so when Chernobyl happened, even though it was not even in her country, there was this widespread fear. And people really have a misconception of nuclear and the power that we really do need to harness because we have so much energy demand in the future, right?
Yeah.
Well, as we start to wrap up, I just wanted to get to know you a little bit more. I mean, a lot of people read your research, but can you share a little bit about your origin story and your background, how you got to be doing your work?
Yeah.
You lived in Japan.
I started my career as a journalist. So I was a TV producer and reporter
same background.
Yeah, exactly. I was at NHK, which is the Japan public broadcaster, at CNBC, at Bloomberg, and I figured out fake news kind of early and realized that the journalists are not always incentivized to put the truth on. They're kind of incentivized to fill time and space. I got disillusioned with the industry, and I got jealous of interviewing people with bigger balance sheets than me all the time. So I got my CFA, Chartered Financial Analyst, and networked and met Cathie Wood, who was then at AllianceBernstein. So she hired me to cover tech on her thematic equity fund at Alliance, and we were big shareholders in a lot of the Web 2 companies. And we realized that there are tremendous network effects when it comes to digital platforms, and the margin profiles of the Amazons, the Googles, the FANG stocks. Basically, we were early in those stocks. We had big positions. And we always had it in the back of our mind that these companies would be disrupted at some point. It's either going to be by regulation or by technology. So kind of both of those have come to pass, right? All the big tech companies are facing antitrust suits in the US, in Europe. I think eventually it's going to be open source databases that take margin away from these companies. So Bitcoin, for me, in 2017, when I first started buying, was the killer app 1.0 of this new cryptography technology that had the potential to take margin from centralized institutions like banks and brokers. So I left Kathy in 2011, worked on the sell side at a Hong Kong-based broker-dealer, writing research, selling research, but just fell down the crypto rabbit hole after traveling so much in emerging markets and watching how the Web 2 industry was evolving. So the folks at VanEck read my research, got to know them. I've been there for 4 years. And when I joined, we had 0 assets in crypto. Now we have $3 billion in crypto across 20 different products, 3 actively managed funds, and a lot more in the pipeline for next year.
Wow, that's a great backstory. All right. Anything you want people to know in terms of research that you're working on that they might see soon?
Well, I don't know when this is going to air, but we have our predictions piece coming out next week. And we put out monthly reports on Bitcoin only, and then on the digital assets ecosystem more broadly. We've got financial models on the top tokens with, discounted cash flow, price targets. It's not an exact science, but we do our best to try to figure out some sensitivity analysis of how big could these assets be under various scenarios. So please check out our LinkedIn and Twitter for that work.
Yes, I will definitely link it in the show notes. And in the spirit of you having worked in television, you know that time is precious. You got to come up with something in a soundbite. So we'll leave people with your very short elevator pitch. If they are not invested in Bitcoin, why should they invest in Bitcoin?
Bitcoin is a hedge on the government taking your money by printing too much fiat. And it doesn't feel very relevant for Americans because the dollar is typically the strongest fiat currency. But for the billion people in the world living in inflation regimes over 10%, it is highly relevant. And many of the institutional investors, will put a little sliver into emerging market equities, maybe 5% of their portfolio. That emerging market index has become very China heavy over the last few years. Meanwhile, China and the US are kind of decoupling. So we really look at Bitcoin as the emerging market asset class, something where with 1% of your portfolio, you're getting exposure to de-dollarization, weak dollar, emerging markets. You don't need to put 5% of your portfolio into an EM equity fund and have a third of that end up in China. So that's our elevator pitch for Bitcoin.
All right. Well, thank you so much. I hope to have you back on, and I appreciate your time.
Thanks, Natalie.
Thank you so much for checking out this episode of Coin Stories. Make sure you're subscribed to the show and hit that notifications button so you never miss any new content. Also, check out our weekly free newsletter at thenewsblock.substack.com. This show is for entertainment and educational purposes only. Nothing should constitute as investment advice, and you should always do your own research. I'm always open to feedback and guest suggestions, so please feel free to reach out at info@talkingbitcoin.com. I'll see you next time.